Accounting profit, also known as net income or financial profit, is the bottom line indicator of a company's financial performance. It represents the monetary gains a business has after subtracting all its expenses from the total revenue generated during a specific period. In simpler terms, it's the money a business makes after accounting for all its costs. Accounting profit is calculated following a set of guidelines called Generally Accepted Accounting Principles, GAAP. GAAP ensures uniformity and consistency in financial reporting, allowing for easier comparison between companies. This essentially means that accounting profit is a standardized way to measure a company's financial performance, allowing for comparisons across businesses and industries. In simpler terms, accounting profit tells you how much money a company has left over after covering all its operational expenses. It's a crucial indicator of a company's financial health and performance. Key components that contribute to accounting profit. Here's a tabular representation of the key components that contribute to accounting profit. Component. Description. Revenue. Total income generated from selling goods or services. Cost of goods sold, COGS. Direct costs associated with producing the goods sold. Gross profit. Revenue minus COGS. Operating expenses. Costs incurred in the day-to-day operations of the business. This includes salaries, rent, utilities, marketing, and administrative expenses. Depreciation and amortization. Non-cash expenses that allocate the cost of assets over their useful lives. Interest expense. Cost of borrowing money, usually from loans or credit lines. Taxes. Income taxes paid to the government. Other income/expenses. Additional sources of income or expenses not directly related to the core business operations. Accounting profit. Gross profit minus operating expenses, depreciation, interest, taxes, and other income/expenses. Please note that the calculation of accounting profit may vary depending on the specific accounting methods and practices used by a company. Calculating accounting profit. The formula for calculating accounting profit is straightforward. Accounting profit equals total revenue, total expenses. Here's a breakdown of the key components. Total revenue. This represents all the income generated by the company through its core operations, such as sales of goods or services. Total expenses. This encompasses all the costs incurred by the company in generating its revenue. It can be further categorized into operating expenses. These are the day-to-day expenses required to run the business, including rent, salaries, utilities, marketing costs, and supplies. Non-operating expenses. These are expenses not directly related to the company's core operations, such as interest on loans, investment losses, or one-time charges. Example. Let's say a bakery has the following figures for a month. Total revenue, $100,000. Operating expenses, $60,000, including rent, salaries, and ingredients. Non-operating expenses, $5,000, interest on a loan. Using the formula, the bakery's accounting profit for the month would be accounting profit equals $100,000, total revenue, $60,000, operating expenses, $5,000, non-operating expenses, equals $35,000. This tells us that after covering all its costs, the bakery has a net income of $35,000 for the month. Importance of accounting profit. Accounting profit serves several critical purposes for businesses and investors. Measures financial performance. It's a key metric for evaluating a company's ability to generate revenue and control expenses. A positive accounting profit indicates a profitable business, while a negative profit signifies a loss. Informs decision-making. Profitability can influence various business decisions, such as resource allocation, investment strategies, pricing structures, and dividend payouts. Attracts investors. Investors rely on accounting profit to assess a company's financial health and potential for future growth. Higher profits generally make a company more attractive for investment. Compares industry performance. By analyzing accounting profit within the same industry, investors can gauge a company's relative strength and competitive position. Tracks growth trends. Monitoring changes in accounting profit over time can reveal trends in a company's financial performance, allowing for better forecasting and strategic planning. Best practices for analyzing accounting profit. To gain the most insights from accounting profit, consider these best practices. 1. Understand the basics. Ensure you have a solid understanding of accounting principles, including revenue recognition, matching principle, and accrual accounting, which are fundamental to calculating accounting profit accurately. 2. Look beyond the headline number. Don't just focus on the final profit figure. Analyze the components of the income statement, like revenue growth, expense trends, and profit margins, to understand the drivers of profitability. 3. Compare profitability ratios. Financial ratios like gross margin, operating margin, and net profit margin can provide a more nuanced picture of a company's efficiency in converting sales into profits. 4. Consider industry benchmarks. Compare a company's accounting profit to industry averages to assess its relative performance within its competitive landscape. 5. Examine cost structure. Evaluate the company's cost of goods sold, COGS, and operating expenses to understand its cost structure. Identify cost-saving opportunities and potential risks associated with rising expenses. 6. Analyze trends over time. Tracking changes in accounting profit over several periods can reveal growth patterns, potential risks, and areas for improvement. 7. Combine with other financial statements. Don't analyze accounting profit in isolation. Consider it alongside other financial statements like the balance sheet and cash flow statement for a holistic view of the company's financial health. 8. Evaluate profit quality. Examine the nature of profits to determine if they are sustainable and recurring. Assess the quality of earnings by looking at cash flow from operations and comparing it with accounting profit. Strategies to improve accounting profit. Here are some strategies businesses can employ to enhance their accounting profit. Increase revenue. Focus on sales growth through effective marketing campaigns, product development, and market expansion. Reduce operating expenses. Implement cost-saving measures through process optimization, supplier negotiations, and waste reduction. Manage inventory levels. Optimize inventory management to minimize holding costs and avoid stockouts that could impact sales. Negotiate favorable terms with vendors. Secure better deals with suppliers for raw materials and other expenses. Improve operational efficiency. Streamline operations to reduce waste and optimize resource utilization. Invest in productivity-enhancing technologies. Leverage technology to automate tasks and improve overall efficiency. Leveraging accounting profit for business growth. Understanding and analyzing accounting profit empowers businesses to make informed decisions that drive growth and sustainability. By strategically utilizing the insights gleaned from this key metric, companies can set realistic financial goals. Accounting profit serves as a benchmark for setting achievable revenue and profitability targets. Optimize resource allocation. Allocate resources effectively towards revenue-generating activities and cost reduction initiatives. Attract and retain investors. Demonstrating consistent profitability fosters investor confidence and unlocks opportunities for attracting capital. Strengthen financial resilience. A healthy accounting profit provides a financial buffer to weather economic downturns and unforeseen challenges. Examples of accounting profit in real business scenarios. Here are some examples of accounting profit in real business scenarios. 1. Retail business. Scenario: a clothing store sells $500,000 worth of merchandise in a year. The total cost of goods sold, COGS, including inventory, labor, and overhead is $300,000. Other operating expenses such as rent, utilities, and salaries amount to $150,000. The business also receives interest income of $5,000 from its investments. Calculation: accounting profit equals total revenue, total expenses. Accounting profit equals $500,000 plus $5,000, $300,000 plus $150,000. Accounting profit equals $505,000 to $450,000. Accounting profit equals $55,000. Interpretation: the accounting profit for the clothing store is $55,000, indicating that the business is profitable after covering all its expenses. 2. Manufacturing company. Scenario: a manufacturing company produces and sells machinery. It generates $2 million in revenue from sales. The direct costs associated with manufacturing the machinery, including raw materials and labor, amount to $1.2 million. The company also incurs $500,000 in operating expenses such as rent, salaries, and marketing. Calculation: accounting profit equals total revenue, total expenses. Accounting profit equals $2 million, $1,200,000 plus $500,000. Accounting profit equals $2 million to $1,700,000. Accounting profit equals $300,000. Interpretation: the manufacturing company has an accounting profit of $300,000, indicating that it is generating a profit from its core operations. Final thoughts about accounting profit. Understanding accounting profit is crucial for any business owner or manager who wants to assess the financial performance and health of their company accurately. While accounting profit provides valuable insights into revenue generation and expense management, it's essential to recognize its limitations. While it serves as a foundational metric for evaluating profitability, accounting profit alone may not provide a complete picture of a business's overall financial performance. Other factors such as economic profit, cash flow, and opportunity costs should also be considered to make well-informed business decisions. In conclusion, while accounting profit is an important measure that helps businesses gauge their profitability, it should be used in conjunction with other financial metrics and analyses to get a comprehensive understanding of a company's financial standing. By doing so, businesses can make more informed decisions, optimize their operations, and ultimately, achieve sustainable growth and success.